In this video I'm going to discuss how taxes are paid by individuals. First of all, there's two classifications of taxes. There's the progressive and the regressive tax. The progressive tax generally affects salaries and bonuses. Basically, the more money that somebody makes, the more taxes that are assessed against them. Regressive tax would be the same. No matter how much income the person makes, they're still going to pay the same tax rate on gas and sales. Now, there are four types of income I'm going to discuss. The first one is earned or active, and that is your salary and maybe a bonus. Second type of income is passive income, such as rental property, or maybe you are a silent or limited partner. A limited partner. It's important. Passive losses can only offset passive gains here. Important to note, passive losses offset passive income. The third is portfolio. A portfolio would be if you hold some type of instrument, asset, and it appreciates. We refer to that as a capital gain, and you might actually make some money. Now, the way we look at portfolios, it's different based upon if it's short-term versus a long-term gain. Now, a short-term gain usually is taxed at a higher amount than a long-term. I shouldn't say higher. It's usually ordinary income. So whatever your bracket is here, so it's not higher. So long-term is usually taxed at a lower rate because we like people to hold their money. In addition, if you have a loss, for instance, let's say that you have a loss of $10,000 this year, and you had a gain of $2,000, you had a net loss of $8,000. And we can take $3,000 of that and take it off on your taxes, assess it towards your current taxes, and then since it's you still have $5,000 in losses left, the difference here, next year you can apply the $5,000, and then the following year another well, you can't do the $5,000, you only can do $3,000 of that, and then the following year you can assess the remaining $2,000, only $3,000 for that following year. Now, a little bit difficult to determine the gain and loss, so we use a cash, kind of a cost basis. So I'm going to use another video to explain that. It takes a little longer. And finally, there's interest. And interest looks something like this. You buy some type of interest-bearing security, and it pays interest. And how is that taxed? Well, it's a little difficult. So let's look at each individual type of interest-bearing I hate to use the word asset, but interest-bearing asset, and see if we can figure out. So I'm going to just go ahead and put them here. I'm going to write the word taxes here, and then I'm going to go ahead and let's try a different color here. I'm going to start doing different colors here. A corporate bond, and we'll look at U.S. securities. Well, a corporate bond, you're going to get taxed at the federal, state, and local, all three of them. Now, with a U.S. securities, this is a treasury security. It's basically just taxed at the federal, not at the state and local. Some other ones to think about here is an agency. Now, an agency is like a mortgage-backed. I'll put the slash there. It looks like market to book ratio. A mortgage-backed security, and generally mortgage-backed securities are taxed at the federal, state, and local. There's something referred to as a municipality, or munis as we call them sometimes. Usually those are exempt from all three, so I'll put here, they're exempt from all three. When I say all three, they're federally exempt, but the state and local generally is if you're in that local or state region, if you buy one from your own state or local municipality. There's also something called a private purpose. Private purpose are sometimes referred to as industrial bonds, like the government wants to buy or issue securities to build a mall or something, jobs. Generally, those are also exempt, but the AMT tax, the alternative minimum tax, can affect that. Also, one other thing to think about here, I'm going to do this in blue, is how I'm running out of space. We're going to move up a little bit here. How the taxes are assessed against the interest payment if the bond is sold to another person during its life. For instance, I'll put a red line here, and this is the period of interest, and let's say it was purchased at this red line. Well, the seller will have to pay taxes on that amount, so the seller has to pay taxes on this amount. And what the buyer will do, the buyer will pay on this, amount. However, the buyer will also have to deduct this amount. So the buyer will has to deduct this amount and will only pay sales tax on this amount. Finally, let's talk a little bit about mutual funds. I'm going to put mutual funds over here under the regressive tax here. I'll put some stuff on here on mutual funds. So I'm going to put on mutual funds. First of all, with dividends and mutual funds, so let's put a box here, kind of distinguish this, running out of space here. So I'm going to put dividends, and I'll put M mutual funds. Well, the first thing we have to look at with these is the income non-qualified, or qualified. Now, non-qualified is also referred to as ordinary. Ordinary. Well, and this is going to be taxed at the ordinary income. Ordinary income. So ordinary income, qualified. So that's pretty easy. Now, it's qualified. It gets a little tricky. Qualified, to determine it's qualified, is that you have to have purchased it. Here's the X date or X dividend date. There's a 60-day period before that, and there's a 60-day period after that. So an extra day. So it's a 121-day period. So basically, if it is qualified, you have to. It's basically taxed on the IRS code or your own tax bracket. Now, let's look at each individual type of mutual funds. There's different types of mutual funds. There are collections of stocks and bonds and mutual funds and how they're taxed. Well, number one, a muni or a municipality. If you're investing in municipalities as a municipality mutual fund, basically you're exempt from taxes. So I'll just put a big you're exempt from all taxes. Number two, if it's a corporate mutual fund, that means it's invested in corporate stocks or bonds. The taxes are ordinary income. So when you receive dividends, it's just ordinary income. Number three, if it is a stock mutual fund, stock mutual fund, a little different. It's based upon the IRS code, and also it's not ordinary income, so it's not ordinary income. I think I may have called this a stock mutual fund. This is with a corporate bond. This was a stock. A little different. Ordinary, not ordinary. Number 4 and number 5. I've got 2 more. If it's a long-term capital gains, then it is based upon IRS again, just like the last one here, and it's not ordinary. So not ordinary. And if it's a short term, it is basically taxed as ordinary income. So those are your 5 classifications of dividends paid from mutual funds, whether it's a municipality mutual fund, whether it's a corporate bond, a stock, a long-term capital gain, or a short-term capital gain. So I hope this helps a little bit understanding how taxes work. Oh, one last thing I forgot to mention, if it's a foreign security. Now, foreign securities, I'm not going to write on here, foreign securities are taxed on the country you are a citizen of. Now, if the foreign tax is withheld, you will be eligible for a tax credit in that amount. So that's if it's a foreign security. I want to mention that foreign security just really quick. And remember, taxes are only paid if income is realized. If you didn't receive anything that year, you don't have to pay taxes on it.